Good afternoon, everyone, and welcome to the second of a four-part Medicare Bootcamp Webinar Series. This educational session is being hosted by Region 10 chapters of HFMA. I would like to welcome our guest presenter for today's webinar, Chad Krcil. Chad is a director at RSM's Healthcare Advisory Group. He has 24 years of national healthcare finance experience focused on regulatory reimbursement, revenue recovery, project management, and service delivery. As an active HFMA member, Chad is a certified healthcare financial professional and holds the HFMA designation of Fellow of Healthcare Financial Management. He also presents Medicare reimbursement strategy courses on a national level for HFMA at courses throughout the year and at HFMA's Annie. So without further delay, I'll hand the call over to today's guest presenter. Chad, please go ahead.
Thank you, Nikki. Good afternoon, everyone, and welcome to this Medicare Bootcamp presentation. I'm thrilled to be asked to do this again this year, and glad that you can join us this afternoon. After this session, some of the objectives that I would like to achieve by talking about the different aspects of the Medicare cost report and how they tie to revenue cycle is when you walk away from this 90-minute session is for you to be able to take a look at some of the high impact areas in the cost report and what drives that reimbursement, and understand that the reimbursement drivers are connected very closely with what goes on in the revenue cycle. Explore the key drivers of the Medicare reimbursement and the revenue cycle function, and how the two different departments or areas of an organization can work together to drive the strategic revenue cycle and Medicare cost reimbursement methodologies to improve not only reimbursement, but also improve the revenue cycle in functions and the cost report processing functions. And hopefully understand how to enhance reimbursement and improve some of those drivers that we'll talk about going through this presentation. I would like to give our participants, whether it's over webinar or live presentations, a few takeaways. And some of the takeaways that we've included here today is we'll give you an idea of what the national cost to charge ratios are, so you can take a look at that and benchmark yourself against what nationally the cost to charge ratios are in the Medicare cost report. We're going to talk about Medicare bad debt, and we'll talk about some of the documentation that needs to be included with your bad debt log in order for bad debts to survive audits, and how the cost report process and the revenue cycle process working together can improve that documentation. We're going to talk about S-10 today and then compensated care, and one of the takeaways will be the charity care log and some of the elements that we've seen are being looked at through different audits of that information. And revenue cycle key performance indicators. So take a look at some of the KPIs that will affect a Medicare cost report. So with that, we'll go ahead and dive right into the presentation. So one of the things that all hospitals are really experiencing is kind of a squeeze. So you see the healthcare organization there in the middle. So decreasing revenue and increasing cost is really squeezing the healthcare organization, and it's really important for the healthcare organization to understand how to increase revenue as much as possible. So what can they do to make sure that some of these things within legislation and reduced reimbursement and the pay for performance, what can they do within their system to make sure they're getting all of the revenue that they should be getting? So that decreasing revenue part of it can maybe not be quite as decreasing. So whatever pay-for-performance guidelines are affecting you, you can do things to make sure that you're getting all of the pay that you should be getting, all of the reimbursement that you should be getting. You know, that increasing cost, you know, all organizations have recently experienced increased technology costs, whether that's through the capital outlays for the medical records, electronic medical records, through the recent ICD-10 implementation and the different things you had to do to get ready for that. So a lot of different things that are increasing the cost. So what we're going to talk about here today is hopefully give you ways to understand how to drive reimbursement to be able to cover some of that increasing cost that organizations are experiencing. So I wanted to start out here and just talk a little bit about the revenue cycle. So what is revenue cycle? So revenue cycle is all the administrative and clinical functions that it takes with the patient that are associated with the patient accounting. So registration, charging, billing, payment, all the collection tasks that are associated with the patient encounter. The revenue cycle is that process that begins when a patient comes into the system and includes all those activities that have occurred in order to drive revenue. So with that patient encounter, there are different things that can be done within the revenue cycle to drive reimbursement. And what's going on in that revenue cycle will ultimately impact how Medicare cost report and the reimbursement methodologies through the Medicare cost report are impacted. So some of the revenue cycle functions, processes, and strategies that we're going to focus on and that impact the revenue cycle and the Medicare cost report are in that first section, some of the things that happen. We have to capture things. So we have to capture our patient days. We have to capture gross charges. We have to collect patient revenue. We have to identify whether our patients are charity care. So we have to look at what is their situation? What can we do to make sure we've qualified them for either charity care, for Medicaid, whatever the issue is with that patient, what are we doing to help that patient encounter at the front end identify this type of information? So by doing some of this stuff up front in the revenue cycle, that's going to help us to capture this information and the processes that we're going to follow. So if up front we're identifying Medicaid patients and they may not be yet signed up for Medicaid, what are we doing to make sure we get them eligible for Medicaid? What are we doing to make sure that we've identified their financial payer so that we can issue bills at the back end and collect payments? So all of those things are going to enhance reimbursement, and it's going to help us on the Medicare cost report utilize that information to drive the different reimbursement methodologies. So this slide here is kind of a picture of a revenue cycle. So end-to-end, what we really want to focus on with the revenue cycle is an end-to-end revenue cycle. We want to look at the front end, we want to look at the middle, we want to look at the back end. So when we're talking about the front end, we're talking about the start of that patient encounter. So what are we doing in that front end to make sure that the rest of this revenue cycle is functioning as it should? Do we have efficient processes in places? Do we have improved processes that is going to improve the accuracy of our collection process? Are we doing anything up front for point of service collection? What are we doing so we can reduce denials in that back end? So what are we doing in the front end on the registration side to make sure that denials on the back end are not occurring? So as we move through this process, we move into our middle revenue cycle. So this is really where a lot of the revenue cycle tie-in to the Medicare cost report occurs. So what are we doing to identify our our Medicaid patients to increase our DSH payments? What have we done to identify Medicare bad debt? What are we doing to make sure that transfer DRGs are properly being identified and we're working those properly to make sure we get our full DRG payments? What are we doing to capture all of our charges? So by capturing all of our charges, we're able to report that correctly on the Medicare cost report. We're able to develop our cost to charge ratios more effectively. And we'll talk about those cost to charge ratios and how those impact your Medicare reimbursement when we start talking about the Medicare cost report. But what's important to know here is we have got to be doing everything on the front end of correcting our charge capture process, correcting our CDM, making sure our CDM is up to date so that we do capture all of our charges. On the back end, what are we doing to make sure that we're billing everything? What are we doing to make sure that after we've billed, and maybe for some reason we're receiving those denials, what are we doing to work those denials? Are we focusing on what happened that caused that denial so that we continue to work that and get paid what we should be getting paid? So that, again, is going to bring the money in the door, and that's going to show up on our PS&R when we go to file our Medicare cost report. So if for some reason we're not capturing all of our Medicare DRGs, that's going to not show up on our PS&R. We're not going to be able to report that on the Medicare cost report. That's going to reduce several methodologies that were paid using the DRGs in the Medicare cost report, such as our DSH payments. So if we're functioning properly in this revenue cycle, we're capturing all of our charges, we're doing our billing, we're working our denials, we're getting paid what we should be getting paid. That is going to show up when we start working on our Medicare cost report and make sure that we're getting paid properly through our different Medicare reimbursement methodologies. So the revenue cycle process, some of the different areas that are part of that revenue cycle process that this is kind of more of a, the other slide was a picture of it. This gives you a little bit more understanding through a description of it. So patient access, scheduling, registration, insurance verification, if we're doing that all up front and we're getting all that information, that's going to help us throughout this process and make sure we're doing our billing properly. Already mentioned a little bit about the CDM and charge capture and coding. So if all our tools and mechanisms are in place to capture, document, and reconcile patient services and charges for our billing purposes, then we're in a much better shape as we go through this process, bill, and work our denials. Another area that is extremely important here is accounts receivable and follow-up. What are we doing to follow up on our accounts receivable to make sure we're getting paid? What are we doing to work our denied accounts to make sure we're getting paid? So if all of these areas are working in conjunction throughout our revenue cycle, then our Medicare cost report processing will be made much easier by having that information correctly and accurately reported so that it will drive that reimbursement that we see through the Medicare cost reports. Now this next slide here, to me, is really kind of scary. And so it's estimated that hospitals have revenue leakage of about 9%. So hospitals are leaking nearly 9% of their expected reimbursements to denials and non-denied underpayments. So if we go back to that first slide that we talked about with that organization in the middle being squeezed by the decreased reimbursement and the increased cost, And then we bring that forward to looking at this slide where we're losing 9% of the revenue that we really should be getting because we're not working our revenue cycle correctly. 9% of your revenue is being leaked by not following or having good efficient revenue cycle processes in place. And those come through denials. So registration area denials are consistently one of the largest sources of denied dollars. So 65 to 70% of this leakage is coming through what is happening at the front end of our revenue cycle. So the registration or the pre-authorization that has to happen in that front end of the registration process is not happening. So that is comprising 65 to 70% of the denial. 65 to 70% of that 9% revenue leakage. Underpayment. So underpaid accounts that have received no payments represent about 23% of this underpayment. So these accounts have insurance, we're not denied, but we're not working it, we didn't bill properly, whatever that issue in that revenue cycle that caused us not to get that payment, that accounts for about 23% of it. So you can see here if a couple issues are fixed on in the revenue cycle, at the front end, middle, and on the back end, we can pick up an estimated 9% additional revenue. So with that, talked about a little bit about the revenue cycle there. So want to talk about what a Medicare cost report is. So just a quick overview of a Medicare cost report. So a Medicare cost report is an annual report. It's required of all Medicare participating providers. And I really like to liken this to a tax form. So at the end of the year, we're sitting down, we're putting together everything that happened in the hospital, total cost, total days, total charges, and then we're going to look at how that's allocated for Medicare and Medicaid purposes, and it's going to come out to what is paid, what is still owed to the provider, or what the hospital owes to Medicare. So it really comes down to that bottom line, just like a tax reform does, a tax form does, of what is owed or what is owed to the hospital. So again, it's total costs and charges, apportionment of those charges to Medicare and Medicaid, and what payments have been received to determine that. So the purpose is kind of different depending on what entity you are. If you're a base entity, such as a critical access hospital, children's and cancer hospitals, what is going on in the Medicare cost report still drives a lot of the payment that you receive. So a critical access hospital is paid 101% of its cost. So the cost report is going to look at the cost, the charges, develop the cost to charge ratio, and in critical access hospitals, we paid 101% of their cost. A PPS hospital, all the information that is in the Medicare cost report is used for rate setting. So it's going to update your MSDRGs, your APCs, other different type of prospective rate methodologies are all going to be updated based on the Medicare cost report. So one thing to really remember here is even though that if you look at worksheet S, that bottom line of what it says you're owed maybe isn't quite as, I'll say, attractive of, I'll say in the olden days when I started in Medicare, when a lot of things are still paid on cost, that page may not be quite as attractive saying the hospitals are owed a lot of money. but that cost report is still extremely important because it sets those rates that you're paid throughout the year. So how is this cost report used? So it's used externally by CMS. As I said, this cost report is filed by all hospitals. So it's a standardized data gathering tool. CMS uses this cost report to determine program liability, reconcile interim payments, and develop future payment amounts and methodologies. So that really is a big component of the external use of the cost report. It's developing future payment amounts and methodologies. So CMS is looking at this cost report and looking how hospitals are overpaid or underpaid through the different methodologies, and they're making changes through those methodologies based on what's reported in the Medicare cost report. And one thing to remember here is they may be looking at a current change. So if we're looking at 2018, they may be looking at a change in 2018, but basing that information on data that was back in, say, 2015. So that the information that are in past cost reports could be used to update your methodologies for current cost reports. An example of this, those that are familiar with medical education when GME and IME came into play. They were using past cost reports to determine the costs that were being used to set those rates. Another really important part of the external use of the cost report is for benchmarking. So it's really a good tool to look at how other hospitals that may be in your market, maybe your same type of hospital, to look at those and see what is going on within their hospitals, whether that be looking at their cost to charge ratios. If they're a DSH hospital, looking at what their DSH and uncompensated care payments were, looking at bad debt, Medicare bad debt, and looking at how much they're being reimbursed compared to how your hospital is being reimbursed. That might identify some red flags there that need to be looked at. Internally, how can a cost report be used? Same as CMS, you can be using that as your standardized data gathering tool to make strategic decisions or start strategic discussions based on that information. Another really good thing is advocacy and education. So this cost report is something that can be used to drive education sessions with other departments within your hospital that you need to work with to gather information. And a big use of that, as we mentioned, is revenue cycle. So using this cost report and having different discussions within the revenue cycle department and how the information that is being used on the cost report, how that's being developed through the revenue cycle, and how there may be ways to improve what's going on in the revenue cycle, and that will improve the payment methodology, whether that be better identification of charges, which will affect your cost to charge ratios, which will affect MSDRG rates, and will affect how you're paid throughout the year. Whether that is how Medicare bad debts are identified and how they're being reported on the cost report, and how the revenue cycle, the patient financial personnel are identifying that information on the Medicare bad debt log, will enhance how that Medicare bad debts are paid. So this cost report can be used, is used externally, but can be used internally for a very specific purpose of identifying ways to improve reimbursements. So just a quick illustration here of implications of the revenue cycle and the cost report. So say there's issues with information that has been derived throughout the year, and you've got to go back and maybe try to create some of this documentation, get a better understanding of what happened through the revenue cycle that maybe is dropping reimbursement that is owed to the hospital, and that could affect the timely filing of a cost report. So if a cost report is not filed timely, Medicare suspends 100% of payments, which is again going to obviously affect the revenue cycle because cash is going to go down, accounts receivable will go up because cash isn't coming in the door. So that's obviously a huge effect. Maybe there's something in the information that's being gathered that causes an underestimation of wage data that is submitted. So the wage index, which is used to drive DRG rates and APC rates, is not being properly reported. So DRG rates go down, APC rates go down, cash goes down, reimbursement goes down. So you can see how those kind of, simplistic examples can affect the revenue that's coming into the hospital. So by working very closely with the revenue cycle, a lot of these things can be taken care of throughout the year and will cause no issues, and reimbursement and cash coming in the door will be what's expected. So just a quick tutorial on some of the areas of the Medicare cost report that will drive that all-important cost to charge ratio. So the first thing is the A series. So this is a classification of expenses. So we start with our direct expenses on worksheet A, and then for Medicare purposes, we need to make reclassifications or adjustments to those costs. We have to make reclassifications to make sure we get the expenses in the right buckets. We have to make worksheet A8 adjustments to make sure that non-allowable costs are taken off the cost report. Or maybe there's some costs from some other entities that belong on the cost report. That could be a prime example of that is home office expense if you're part of a chain organization. How is that home office expense getting allocated? Hopefully through a home office cost report. And how is that getting onto the Medicare cost report so that you have all of the expenses that you should have? So, whether you need to offset revenue, disallow non-allowable expenses, bring on related party expenses, those things are all being taken care of through worksheet A. So by looking at worksheet A8 on our adjustments, so looking at worksheet A, our direct costs, worksheet A6, our reclassification, and worksheet A8, which are either bringing on allowable costs or disallowing non-allowable costs. This is allowing us to get all of our direct expenses into the right buckets. We then go through a series of step down of expenses. So we've got all of our expenses that are in overhead cost centers. So there are administrative cost centers of the hospital. They're non-revenue producing. We need to get those costs stepped down to all of our revenue producing cost centers. So how do we do that? Well, it's a somewhat complicated process, but this kind of simplifies it. We really just look at our costs in those areas and how we're going to step those down through B1 statistics that we've set up. So based on those statistics, we can step down, just for an example here, capital cost is done on square feet. So we're going to step down all of the costs in the capital cost center to all of these different cost centers based on the square foot of the departments within the hospital. Employee benefits, we're going to step those down based on salaries. Administrative in general, we'll step those down based on total allocated cost. So that's just kind of 3 examples of probably 17 to 18 different overhead cost centers that a hospital will have and how those would get stepped down. So at the end of this process, all of those overhead costs, so all of those administrative costs, that are in a non-revenue producing department are stepped down to our revenue producing departments, which will then go on to create our cost to charge ratios on worksheet C. So worksheet C is really the bridge of the cost report. And this really ties into our revenue cycle through the middle part of that revenue cycle picture that we looked at originally. So whatever we're doing with our charge capture, our pricing, all of those different type of methodologies, what's going on there? So that's going to allow us to capture our charges properly. And when we look at worksheet C, we have what we call that bridge. So we talked about, we just talked about worksheet A through A-8. So that's all of the total costs. We allocated all of our overhead costs down to the revenue producing department. And now we're looking at worksheet C, which is identification of all of our revenues. So we're identifying the revenues that occurred throughout the year. All of the charges that occurred throughout the year will be reported on worksheet C. So we have our fully allocated departmental costs. We divide that by total department charges, and we have a cost to charge ratio for each ancillary department. So that leads us to a national cost to charge ratio. So this is updated every year in the Federal Register. And I've got an example here of the past 2 years. So we've got the fiscal year 2017 and the fiscal year 2018 cost to charge ratios. So hospitals' cost to charge ratios are going to vary. So if you were to look at your cost to charge ratios and then look at the national cost to charge ratios, they're not going to be exactly the same. This is all of the hospitals' averages of cost cost of charges. So what's important here is that you're in the right direction. So if we were to look at, say, implantable devices, the average is in 2017 it was 0.331, in 2018 it's 0.332. So if you were to look at that and see that your implantable devices were 0.08 or 0.90, you would see that that's quite a bit different than what the implantable devices are. You know, what's going on there? What's driving my cost to charge ratio? Are we doing something differently there that is either lowering it or maybe increasing it too much? Maybe it's what you're doing within your hospital and how things work in your hospital. Maybe that's exactly the way your cost to charge ratio should be. But again, by just looking at what your cost to charge ratio is on your Medicare cost report and comparing that to these in the Federal Register, it'll give you some ideas of what is going on in your hospital and what's driving your cost to charge ratio. Could be an issue with how things are priced. Could be an issue with how charges are captured. So it just gives you that first kind of look into maybe there's something I need to look at to make sure that my cost to charge ratio on my cost report is correct. We'll point out just a couple areas here too. Over the last few years, MRI and CAT scan are cost centers on the Medicare cost reports that have had to be broken out. You'll see if you look at MRI and CAT scan on this slide, they're fairly low cost to charge ratios. That has to do with one of the biggest items that has to do with is maybe not all the expenses are being captured properly in MRI and CAT scan. Radiology is where this cost is normally kind of grouped, and we've now broken out MRI and CAT scan. Well, maybe there's some additional cost in radiology, say salaries or benefits or other types of things within that cost that aren't getting stepped down properly and getting into the MRI and CAT scan. So this obviously is a national cost to charge ratio. So it's one of those initiatives that really hospitals should be looking at with their MRI and CAT scan as they break this out. Are we capturing all of our expenses there accurately? The charge side of that, really, that's probably being captured correctly because there are revenue codes that identify those, but that is something you want to look into too to make sure you are capturing the appropriate amount of MRI and CAT scans. And you don't want to be capturing too much there. You don't want to be capturing not enough there. But again, by looking at your cost to charge ratios on your cost report, doing that benchmarking to these national averages, you can see where there might be some issues that you need to take a look at. So some of the issues that come into play, as I mentioned, with development of these cost to charge ratios, one of them are pricing. And just a quick pricing 101, a lot of hospitals will just across the board do a 2% increase. Some hospitals will do a strategic price increase where services are priced higher based on their sensitivity that they've developed in this process. Rational pricing is incorporating cost as a basis for how much your charge per service is. So you're kind of moving toward a defensible pricing strategy here. Really taking that rational strategic pricing approach is really the way that you want to go. So because rational strategic pricing leverages both rational and strategic pricing together. You're going to model contracts, you're going to develop sensitivity, you're going to look at analytics, how that is used to drive how to price items. But one of the really big things when you're doing a strategic pricing project, so your revenue cycle may have undertaken this strategic pricing project, you want to make sure that your organization is not doing this in a vacuum. And what I mean by that is, are all the parties that need to be involved within this initiative, are they involved in this initiative? So revenue cycle is maybe taking the lead on this, but have they bought in the Medicare cost report personnel? How is what we're doing in this pricing strategy going to affect the Medicare cost report? How is it going to affect those cost to charge ratios that are being developed? Once the new pricing strategy is developed, we need to take a look at how that, an estimate of how that's going to affect the charges that are going to appear in our working trial balance and then be reported on our cost report to drive our cost to charge ratios. So again, if we're doing this in that vacuum and not involving all the parties, that piece of the puzzle may be left out of the complete puzzle, and you won't know the answer to that until you complete a Medicare cost report at the year end and you see that your cost to charge ratios have drastically increased, decreased, whatever the issue is. Now you got to figure out what's happened. This is problematic for both a critical access hospital and a PPS hospital. Obviously, if you're a critical access hospital, if your cost to charge ratios drop significantly, that's going to impact how much you're going to owe back at the end of the year. If they've increased drastically, you may be getting a lot of money that you weren't expecting. So by upfront, the revenue cycle and the cost report, people working together and talking about how these are going to impact the revenue cycle and the Medicare cost report, and therefore the overall reimbursement to the hospital, that full picture is able to be taken into account. And issues that may be happening can be resolved before the final decision is made. So this is one of those areas where working together will really help identify issues, get them resolved, and understand how they're going to impact the final reimbursement. CDM, I mentioned that earlier, is another one of the areas in that middle revenue cycle that we want to make sure we're looking at. Lost gross and net revenue. So if we're not capturing, if CDM is not updated and not fully reflect the services, procedures, everything that's being performed, and we're not capturing that, we're not able to bill that, that's going to impact our cost to charge ratio. We're going to have missed gross revenue. And at the end of the day, our cost to charge ratios and our reimbursement are going to be affected. So again, an area where these just two examples there of if the revenue cycle and the Medicare cost report, people are working together to understand what's going on in those two areas can increase the reimbursement. So I want to talk about a few areas here of some large reimbursement areas, both on the Medicare and for the Medicare cost report and for the hospital, and some of the different things that occur in each of those to drive the payments. First one we're going to talk about is Medicare bad debts. We'll talk a little bit about DSH reimbursement, and we'll talk a little bit about S-10. So Medicare cost report. So an allowable Medicare bad debt. What is that? So it's unpaid Medicare deductible and coinsurance amounts that are related to covered hospital services. They are reimbursed by Medicare at 65% of actual Medicare bad debt write-offs. So we've throughout the year identified our Medicare bad debts. We've worked those the way our policy has said we needed to work those, meaning, we've done our billings to the patient. We've waited our 120 days before write-off. We've turned over collection agency if that's part of the hospital's policy. We've not claimed that Medicare bad debt till it is returned from the collection agency. So that's a vital part of this process, has been for the last several years, but it's still a process that gets overlooked. Is if it is at the collection agency, it is not yet deemed uncollectible, and it should not be reported as a Medicare bad debt until it is returned. Now, as I first mentioned with the Medicare bad debt, it's related to covered hospital services. So we want to make sure that it does exclude professional fees, fee screen, parts of that. So coinsurance and deductible for those areas are not a part of the allowable Medicare bad debt. Must maintain sufficient documentation. So all of this information needs to be identified on the bad debt log so that we have a record of it, and we must be able to access that documentation a year, 2 years down the road. So whenever the auditors are auditing the cost report, which again could be a year, 2 years down the road, we need to be able to make sure we've got this information maintained and can access that information. So if we provide a Medicare bad debt log that has sufficient information as to all the different things that we have to make sure we have for a Medicare bad debt to survive an audit, on that log, it makes it much easier to go back a year, 2 years down the road and identify that. Already mentioned reasonable collection efforts. So those collection efforts have to be the same for all of your different payers. Can't be different for Medicare, and then your commercial payers have different collection efforts. So if you send your commercial bad debts to a collection agency, your Medicare has to be sent to a collection agency. You can't bring back your Medicare bad debts and leave your commercial bad debts at the collection agency. They all have to be bought back at the same time, in the same duration of time that's in your policy, or you can leave them at the collection agency and continue to work all of the bad debts. What I mean by that is when your bad debts are audited, they are now starting, CMS auditors are now starting to look at your collection agencies to see what they have done to collect these Medicare bad debts. Meaning, are they the same efforts at the collection agency being conducted for a Medicare bad debt as they are for a commercial bad debt? They don't want to see a Medicare bad debt be sitting there and no collection efforts being done on them, while the same type of commercial bad debt is being worked much more aggressively. So they are looking at those different processes at the collection agency also. So you want to make sure that both internally within your hospital and externally at your collection agencies that there are reasonable, consistent collection efforts for all of your entire population of bad debts. And then the last point here is the debt does actually have to be uncollectible when claimed as a bad debt. So again, if the bad debt is being worked at the collection agency, it's not an allowable Medicare bad debt. It's not yet deemed worthless. If you have worked your bad debts, you pull them back from the collection agency, and on that very day the patient walks in and pays $5 on the account, the process starts over. The 120-day period starts over. So you cannot claim that as a bad debt because it's not yet deemed uncollectible because a payment has been made on it. So some of the different types of a Medicare bad debt. So there's the traditional, regular, non-indigent bad debt. So this is a Medicare beneficiary and not eligible for Medicaid and is not a charity, does not meet your charity policy. Reasonable collection efforts are required. So everything we just talked about there are required for a traditional, regular, non-indigent, non-Medicaid crossover bad debt. A second bad debt is dual eligible Medicaid crossover bad debts. So these are traditional Medicare beneficiaries who are also eligible for Medicaid. So the one thing that has to happen here is you do have to bill Medicaid for this. So you will have to show an RA. That's really your collection effort that you have to do. You have to bill it and be able to show that Medicaid didn't pay anything or that they maybe paid a little bit and you remove that from the bad debt that you're claiming. No other collection efforts need to be conducted for a dual eligible Medicaid crossover. But you do have to bill and have that RA to show that you billed. So this is one of those areas where if through the revenue cycle at the front end, the registration process identified that this patient is eligible for Medicaid, so we've classified them as Medicaid, or they are eligible for Medicaid, are they actually signed up for Medicaid? Do we have them registered for Medicaid? So if not, what can your registration do to start getting them through that process of being approved for Medicaid? So that's an area where the revenue cycle and the cost report people can work together to make sure that you're identifying that they're working that up front so that on the back end for these bad debts, we know who were Medicaid eligible. The third bucket for Medicare is the indigent charity care. So this is, again, a traditional Medicare beneficiary, but they've been deemed indigent and meet your charity policy guidelines. So with this, no collection effort is necessary. Again, you just have to make sure that they've met your charity policy guidelines and have been identified and are being identified so that they can be pulled in your Medicare bad debt log. When you pull that at the end of the year, you've got the transaction codes that identify each one of these different areas, and they can be pulled from your system. So this slide is kind of one of those takeaways that I talked about at the beginning. It puts those different buckets that we've got: traditional, dual eligible, indigent, charity, and tells you kind of those different things that you have to do to collect on these buckets of bad debts. So again, traditional cannot be claimed as a bad debt until returned from collection agency. Must be at least 120 days, so you have to follow the 120-day rule. Write-off must be at least 120 days from the date of the first bill. Collection efforts must be documented in the patient records. Collection efforts must be consistent among all commercial and Medicare bad debts. And one of the things that come into place here is the timely billing. That's something that is really being looked at quite heavily through an audit. So, excuse me. Normally, what we've been seeing lately is that the bill must be issued within 90 days from discharge or 60 days from the Medicare payment. And if the bill wasn't issued within that time frame, we started to see where CMS auditors will disallow that bad debt for timely billing issues. So again, another issue where working closely with the revenue cycle and making sure they understand this issue of the timely billing. So if there are any issues in the revenue cycle where timely billing is not being done, that whatever is causing that issue is being fixed, because again, that will hurt you on this back end through this process. So if it is not billed within that kind of estimated time frame, you stand a chance to lose that bad debt. And not only that bad debt, but much more, because those that are familiar with how the audit of bad debts works, you know that it's extrapolated to the population. So error number is calculated at the beginning of a bad debt audit. So for each error, you may lose, $15,000, $16,000, $17,000 for each error. So once that Medicare bad debt is audited and it does not meet all of the 7 highly effective habits of the bad debt, it's counted as an error. And it isn't just that $1,000 deductible that's being taken out. It's that $16,000 amount that's being taken out. So an error amount is calculated, and for each error, that's the amount that's going to be taken out. So again, really important that these different areas are being looked at, so that if you do have a bad debt that's on that Medicare bad debt log, you've identified that beforehand and taken that off of the log. So it's not an error that's going to get caught in a Medicare audit. So again, a good process to follow here is, halfway through the year, pull bad debt log and do a mock audit on that, and take a look at 60 accounts and make sure they are following all of the different collection processes that need to be followed before they're written off. And if not, number one, you're making sure they're not on your bad debt log, and you're correcting those procedures so that the next 6 months at the end of the year that you look at, you don't have that issue. Dual eligible, again, that's the Medicare, Medicaid. Again, no collection efforts need to be followed here, because you do have to bill. Indigent and charity. So indigence must be determined by the provider. Again, key issue here, by the provider, not by the patient. Should take into account all of the patient's resources. Must determine no other source is responsible for that. And the indigent determination must be documented in the patient records. Collection policy must be consistent among all payers. So again, it's got to be the same for how you determine a Medicare indigent patient has to be the same as you would determine any indigent or charity-related patient. Wanted to skip to this field here because this is really the meat of the bad debt. What you're going to supply to the Medicare, what you're going to get through your patient financial revenue cycle services, and what you're going to supply to CMS through your Medicare cost report submission. So this is kind of another takeaway. On one side, we've got the required fields, and on the other side, suggested fields. So for a bad debt to be a bad debt log to be accepted, all of those required fields need to be on there. We've added suggested additional fields that you should be putting on there. This helps you be able to identify this bad debt and where to go to look at some of this, get the information that's going to be pulled if this information is audited. So patient account number, medical record number, total covered charges, recoveries, hospital charity care determination, if you waited 120 days, the date returned from collection agency. So if you add all of those different things in there, it makes it much easier to find the documentation for this Medicare bad debt and be able to survive in audit. Another area that provides quite a bit of reimbursement to hospitals if you qualify for DISH, so if you serve a disproportionate share of low-income patients, your hospital will qualify for disproportionate share payment. So this is another area that we want to take a look at. This is one of those areas that have changed over the years. With the enactment of the Affordable Care Act, the payment has been split into two payments. So we have the DISH payment and the uncompensated care payment. So we've got to look at those two areas separately. But specifically, the ACA reduces Medicare DISH payments by around $22 billion between 2014 and 2019. So there's a pretty good reduction there. So hospitals want to make sure they're getting everything they should be getting paid for DISH and what they're getting paid through their uncompensated payment. So just quickly, hospitals qualify for DISH if they are serving a high share of disproportionate low-income patients. So there's two fractions that go into this. First of all, it's your Medicare fraction, so that's SSI days, and that's supplied to you by CMS. And then there's the Medicaid percentage, and that is your total Medicaid days divided by total days gives you your Medicaid percentage. So this is really the area on that you can really affect, the hospitals that are DISH can really affect. If they're Medicaid, we want to make sure we're identifying them as Medicaid. We want to make sure we're looking at our whole population to identify all of our Medicaid, not only paid, but eligible but not paid. So we want to make sure we've looked at that whole population. Again, why this is pretty important when we're talking about revenue cycle is if up front of that revenue cycle, we've identified all of our Medicaid patients, we've identified those that are eligible but maybe haven't got registered for Medicaid yet, we've started that process to get them Medicaid eligible. So again, if by the two areas working together, we can enhance what our Medicaid percentage is. So when we put these two percentages together, the Medicare fraction and the Medicaid percentage, when we put those two together, if that percentage is greater than 15%, your hospital is eligible for this additional payment. If it's greater than 20.2%, it's a super dish hospital, and there's higher factors that are used to determine the amount that you're going to get paid here. So beginning in 2014, as I mentioned, this payment methodology changed. You now receive your dish payment, your traditional dish payment. You calculate that just like it always had been calculated, but you're only going to receive 25% of that. The remaining 75% is going to go into this pool, and a portion of that will be redistributed to hospitals based on their uncompensated care that they provide. So we're going to talk about we're going to talk quickly about the factors here, and then how that has changed, will be changing going forward. So factor one, as I mentioned, it's your traditional dish is multiplied by 25%, so you're going to get that paid for your dish payment. Then that pool that's created by that 75% will be used, a portion of that, to pay your uncompensated care part of this pool, which is based on factor two, which is percent of individuals without insurance, started at 18%, and now they go through this calculation to determine what your factor two is this is for 2018. And then factor three in the past had been calculated similar to how your SSI is, so Medicaid, based on Medicaid days and Medicare SSI days. Well, going forward, this factor will now be being phased in over the next 3 years based on the information on your S-10. So really important that the information on your S-10 going forward is reported correctly. This is a kind of a table of where it started in 2014 and in 2018 where we stand. So in 2018, the dish estimate is $15.5 billion. That's what would have been paid to dish hospitals without any changes. So if the Affordable Care Act had never came into play, dish hospitals would have received their share of that $15.5 billion based on how traditional dish is calculated. So factor one, so this is the uncompensated care pool, is 75% of that. So you can see 75% of that is $11.6 billion is out there in this uncompensated care pool. And then by using the percent of uninsured and the by using the percent of uninsured calculation, the dollar amount is determined at $6.7 billion. So of that $11.6 billion, $6.7 billion will be redistributed to hospitals based on what their uncompensated care, based on factor number three. So as I mentioned with factor number three, CMS has determined that they're going to phase in the use of S-10. So they haven't been using S-10 for several reasons over the past year since this has come in, because the information has not been really reliable. So there hasn't been really good instructions out there, and the information that's been being reported there has not been being reported accurately based on kind of the lack of instruction. So CMS has been doing a lot over the past several months in enhancing their instructions for S-10, and they're conducting audits on S-10. So they're at a point now, so for fiscal year 2018 and going forward, they're going to start using the information that's reported on S-10 to drive that factor three component. So they're going to start off using 2 years of proxy data. So 2012 and 2013 will be being used in the fiscal year 2018 payments, and 1 year of proxy data will be being used to determine that our first year of that factor 2 payment. So we'll start out in 2018 using 2012, 2013 proxy data, so that SSI data that had been determined in the Federal Register, and 1 year of the S-10 data. So it'll be, kind of, if you look at it, it'll be 66% will be based on the proxy data, that SSI data in the Federal Register, and 33% will be used based on your S-10 information for 2018. For 2019, 2 years of the S-10 information will be used. That's 14 and 15. And then 1 year of that proxy data for 2019 payments. Then for 2020 and going forward, it'll be all based on S-10. So you can see the importance of S-10 going forward and why it's really important with all the changes that have been occurring that hospitals take a look at how they're reporting that information. So just a key wrap-up, or a quick wrap-up on the DISH drivers. Three things that really drive this. And two of these things are something that can really be affected by the hospital and what they do. Number one is DRG payments. How can the hospital affect their DRG payments? Through the revenue cycle, by making sure that everything that should be billed gets billed appropriately. If there's any denials, if there's any Medicare denials, those Medicare denials are getting worked so that we get our DRG payments. Hospitals need to look at transfer DRGs. So where are these patients being discharged to? So if they're being discharged to home, are they getting their full DRG? If their records are saying they're being discharged to a post-acute area, which reduces that DRG, and they really don't, they get discharged to home, what's being done to make sure that that's being identified and you get your complete DRG payment? So by having the most DRG payments that we can get based on our services, that will drive our DISH payment based on our DISH factor. Medicaid eligible days I already talked about there. So, if we can enhance our Medicaid days, if we're doing everything we can to identify Medicaid days on the front end at the registration process and at the back end through identifying all of our Medicaid days, will increase our DISH payments. So kind of we'll do a quick tour of S-10. This, as I said, has changed quite a bit over the last several months. And it's really important for hospitals to take a look at their S-10 and make sure that the information is being reported correctly. Now, you've had an opportunity to look at and correct your S-10 for 14 and 15. There's been a few developments in that. The first deadline for having S-10 information resubmitted for 2014 and 2015 was by the September 30th of this year. That was the first deadline. That deadline got extended to August 31st. Well, that deadline has just now been extended again. So you've got additional time to look at your days through January of 2018. So based on a lot of changes that have occurred, you've got an extension now for getting 14 and 15 amended. So they've given you through the beginning of the year to get the information amended. So if you've done this already, you're probably in good shape. If you thought you maybe are caught behind the 8 ball with this and didn't or haven't gotten done and didn't know how you were going to get that done by the end of October here within 10 days, you've now got a little bit additional time to take a look at the information, to look at the new instructions that are out there, because there are a lot of them. A good places to look at that, look for the instructions are in the cost report software themselves, and in several corrections to the Federal Register that have come out that will tell you what the new instructions are for. But basically for S-10, what we're looking at here is overall cost to charge ratio, because that's going to determine the ratio that your charges are going to be multiplied by to come up with your uncompensated care cost. So again, that cost to charge ratio is being developed based on the information we've got in the cost report. So everything that was done to develop the cost to charge ratios on worksheet C, that information is going to be used to develop this overall cost to charge ratio. We want to make sure our charity care charges are appropriately identified. We want to make sure that our bad debts are appropriately identified. So those are some three key areas that we want to pay attention to on our S-10. So as we just mentioned, CMS is transitioning to using S-10 for the distribution of the Medicare DISH uncompensated care pool. So if you haven't taken advantage of this new window for you to look at it, might want to think about doing that. So we talked about the phase in of that S-10 for the uncompensated care payment. The other big thing about this is, Congress has considered linking hospitals' not-for-profit status to their provision of charity care. So, how much charity care is the hospital providing? That could become a factor in that not-for-profit status for hospitals. So really, really important that S-10 information is being correctly reported on S-10 for those two reasons. So again, as we talked about here, some of the factors in there, uncompensated care, so that's charity care and bad debt, which includes non-Medicare bad debt. Charity care is how the hospital has demonstrated that the patient is unable to pay. Again, the hospital must demonstrate through their policies that they're unable to pay. They are looking very heavily at non-Medicare bad debt. That's part of your uncompensated care. So health services for which a hospital determined the non-Medicare patient has the financial capacity to pay, but the non-Medicare patient is unwilling to settle those claims. Non-reimbursable Medicare bad debt, the amount of allowable Medicare coinsurance and deductibles considered to be uncollectible but are not reimbursed by Medicare. So these are a quick overview of what these are, but really good instructions are, and they've just changed recently. So really, you can take a look at the instructions for S-10. One thing I do want to mention here is the timing of some of these things. So these are the timing of these things are actual payments received or expected to receive for services delivered during the cost report period. Again, when we're talking about charity care, a total initial payment obligation of patients for care delivered during the cost report period. This is one of those things that have changed depending on whether it's before October 2016 or after October of 2016. There's kind of a different definition of what they're saying should be reported as charity care. So again, you want to take a look at how your hospital is reporting those. For the 14 and 15, have we reported those correctly for the new instructions for pre-October 2016, and going forward, are we reporting them correctly for post-October 2016? Here's one of the charity care logs, takeaways that we talked about. These are some of the things that I think will help you identify your charity care and be able to survive audits of your charity care if you have these different type of information in your log, and be able to identify and document those if you were to go through an audit of your charity care. This is another takeaway for you to kind of take away a few of these things we've talked about, but they're key drivers to the different types of reimbursement. We talked about the DRGs, and how to make sure you're getting your DRGs are being reported correctly. One of the big things here is with your wage index. Hopefully, all of your hospitals take advantage of the wage index review period. So for specific years we're looking at, this just occurred here this summer, and at the beginning of September had to be reported, had to be amended. But you want to take that advantage of making sure you get your wage index reported correctly. You really want to get your wage index correctly when you submit the cost report, but you always want to take advantage on the back end during that period and make sure that if there's any changes in your wage index or things that came to your knowledge after the cost report was provided, that you've identified that. But really kind of a key theme as you were looking through this revenue cycle is the DRG payment. And you really want to make sure that you are billing properly for everything and you're working all of the different denials or transfer DRGs or things that may affect what your DRG is. You want to make sure you're working those properly and getting paid. So to kind of start to wrap this up, some what I call strategic recommendations. So just things that as you walk away from this webinar and maybe talk about some other things within your organization, it's really some things that you can look at to improve in these areas. Focus on your strengths. What are you doing well within your organization? Can you improve upon those, or can you make sure that all of the different areas of your hospital are doing these same type of things? Improving revenue performance. This is one of the big things we've talked about through this presentation, is what's going on within your revenue cycle. How can you improve any processes within your revenue cycle, whether that be, as we talk about, pricing strategy, CDM capture, charge capture strategy. At the front end, what are we doing at the front end to identify everything we need to know about the patient? What insurances they have? Would they be eligible for Medicaid if they are not, and can we get them eligible for Medicaid? Have we done everything up front pre-authorization wise that needed to be done to make sure there's no issues at the back end in getting paid for this? At the back end of that cost report, what are we doing to make sure that we are eliminating that 9% revenue leakage? Has everything been done at the registration side of this? And has everything been being done on what we call the underpayment side of this? So if for some reason you're being underpaid, are you tracking what you should have been paid and realize that you were underpaid and now are working those underpayments, those denials and those underpayments? Is your hospital focusing the resources it needs to on those two areas to be able to make sure you get paid? Reimbursement opportunity assessment. Really important to have someone take a look at your Medicare cost reports. If you're the preparer of that cost report, are you having someone else, whether that be inside your organization or outside your organization, someone look at those cost reports and look at these different reimbursement drivers that we've talked about throughout this presentation to make sure that you've captured everything that you should have captured, so that if you're a PPS hospital, all your PPS rates are being set appropriately. If you're a cost-based facility, are you identifying everything and being paid properly? So really important. If you're one of those, if you're a person that prepares these cost reports, you're in the weeds, preparing the cost reports, you're deep in the weeds, you get done with the cost report, and it's very easy for something to be overlooked. So having someone else take a look at that will identify some opportunities that you may have missed. Talked about several of these issues here already. One of them we haven't hit is the charity care funding assessment. That S-10 that we talked about. Are you reporting everything properly on S-10? So the areas that are affected by that S-10 reporting, DISH in particular, are being reimbursed properly. What are you doing to reduce costs? So in that first slide we took a look at with a hospital squeeze, in that we reduced reimbursement and that increased cost. What have you done to target things to reduce cost? Is there duplicate services? Is there duplication going on in your facility? And how can you target eliminating that? Operations consolidations. Have you looked at things that aren't as financially impactful in your organization that maybe you should consolidate? Maybe you should think about discontinuing. Maybe those services are offered throughout the community in better ways. And if you were to eliminate it in your hospital, how would that improve your financial performance? So in conclusion, I hope throughout this thing you've seen some of the key drivers of reimbursement that tie into the revenue cycle and what could be done to improve those areas. Taking a look at it and being able to create kind of some key questions, one or two questions around some of these things to see what your organization are doing with them. What can be done for a better collaboration between the revenue cycle and the reimbursement department? So for those to collaborate to get a full understanding of both departments and see how that can enhance the reimbursement for your hospital. So with that, I think we've got about 8 minutes here or so. We can open up for questions, or if you want to get back to me with questions, my information is provided here, and feel free to call or email me with questions that you have or that may come up after this presentation. I'll be more than happy to take a look at the question and get back to you with that. So with that, we can open it up for questions.
Great. Thank you, Chad. Great balance of strategic and tactical insights in that presentation. Before I take our first question, I would like to just remind everyone to type in your questions using the questions chat panel located to the right of your screen, and we'll take as many as time will allow. I will address a couple questions, one question regarding the replay. This session has been recorded, so if you'd like to listen to it again or share it with someone else within your organization, you will have the ability to do so. All right. Also, copies of the slides. So I did see one question come in. If you look to the right of your screen, you should see a panel called Handouts. It should be second from the bottom above the questions chat. You can expand by pressing that arrow pointing to the right, so it's pointing down, and just click on that PDF icon and you will have access to the slides right now. All right, so it does not look like any questions are coming in just yet. If you are shy, Chad has been nice enough to provide his contact information, which you see on the screen right now. But I'll just go ahead and mention really quickly, just in case you're gathering your thoughts for the questions. This is the second, as I mentioned, of 4 different Medicare Bootcamp series. The next session is scheduled November 7th, and the topic is Reimbursement Compliance Foundations. There is a separate fee for this session, but again, it is provided to an unlimited number of people within your organization. So to learn more and register for this and other upcoming events, be sure to visit hfma-co.org. All right, Chad, it looks like you did a very thorough job today in your presentation because no questions have come in. You may see your inbox, though, populate with a few. As you exit today's event, you will be automatically routed to a survey. So please share your thoughts. Be sure to provide the email addresses of everyone in the room just to make sure that everyone receives proper credit. Here we go. We got one question in right before the buzzer, and it reads, do you see a lot of organizations preparing their cost reports internally or not? They are certainly daunting, and we hire external help. Any insights there, Chad?
Yeah, good question. You know, it's a mix. We see a lot of hospitals that do it internally, but a number of those that do it internally, as I mentioned, do have an outside consultant do a review of that. So they've got their personnel review the cost report, and then they have a review done outside of the organization to catch some of these different things we talked about. So as I mentioned, that is definitely a recommendation that I would give to everybody here, is that cost report is looked at somebody else that is knowledgeable with Medicare, obviously, and the different regulations. So whether that's someone within your organization or outside your organization, if you are doing it internally, it's a really good idea to have another set of eyes take a look at it and make sure that everything that should have been caught was caught.
All right. Thank you for that. And on that note, I think we will wrap up for today. So on behalf of the entire HFMA Region 10, I would like to thank everyone for participating in our second annual Medicare Bootcamp Series. Thank you again to our guest presenter, Chad from RSM Healthcare Advisory Group. Chad, we're glad that you're able to join us.
Well, thank you very much. I appreciate it, and thank you everybody for listening for the last 90 minutes. And again, I do really mean, if you have questions afterwards, feel free to let me know, and I'll get back. We can either talk on the phone or email, and we'll get your questions answered.
Perfect. Thank you. Have a great afternoon, everyone.